Disclaimer. All contents, ideas, opinions and information shared or implied herein are for informational and educational purposes only. Hello everybody, welcome to Sunny the Eggman YouTube channel. Today we will talk about 3 best REIT stock in Singapore. REIT market is a combination of value asset classes which are mature in Singapore. Among the asset classes, office, retail, residential, industrial and hospitality REIT are the 5 main asset classes in Singapore. Why should we invest in Singapore REIT market? What are the returns we expect from this investment? First of all, with a population of 5.7 million people, Singapore's properties have always gained popularity and high demands among local and foreign investors. It serves as a regional hub for foreign investors due to its low taxes and rules of law. For this reason, Singapore accounts for more than 50% of Asian regional headquarters. This indirectly helps to boost the country's demand for office, retail and industrial asset classes. To add on, the political stability in Singapore makes investors feel secure and safe to invest in the country, and they expect continued growth of industries and businesses in Singapore. Hence, investing in REIT stock is relatively safe, and we can expect an average dividend yield from 5% to 8%, which will be paid out quarterly or semi-annually. In this video, we would like to recommend top 3 REIT stock to buy in 2021 based on our analysis. First is Ascendas REIT, SGX trading code, A17U. Ascendas REIT has an issuer rating of A3 by Moody's Investor Services. Its manager, Ascendas Funds Management Singapore Limited, is wholly owned subsidiary by CapitaLand Limited. Being one of the pioneer industrial REIT in Singapore, Ascendas REIT has a well-diversified portfolio of 96 properties in Singapore, 36 properties in Australia, 49 properties in the United Kingdom, Europe and 30 properties in the United States as at the 30th of June 2021. It shows a huge jump from 8 properties to 211 properties since its first IPO in 2002. In Singapore, Ascendas REIT portfolio includes business and science park properties, integrated development, amenities and retail properties, high specifications industrial properties, light industrial properties and logistic and distribution centers. It has a market capitalization of 12.4 billion Singapore dollars currently. Why should we buy Ascendas, and when to buy the share? Firstly, we can see a steady growth in revenue across 4 years' time, which is a big jump from $862 million to $1.04 billion, which is equivalent to an increase of 22%. Next, it shows an increasing profit in last 3 consecutive years, with at least 4 profitable years. Even though in year 2020, it is a challenging year with the presence of COVID-19 pandemic, Ascendas REIT is still presenting a gross profit of $776 million, increased by 44% from year 2019. This is mainly due to diversification strategy implied in Ascendas REIT. Among its portfolio, there is no any tenants which takes up more than 5% of Ascendas REIT gross rental income. This significantly reduces the concentration risk, whereby even some of the tenants leave the properties, Ascendas can easily find another tenant without worrying about a significant drop in rental income. On the other hand, Ascendas REIT provides a decent dividend yield of 4.71% in year 2020. This is considered relatively good yield in COVID-19 pandemic, especially when REIT in other asset classes are suffering from huge losses. To add on, the future prospect of Ascendas is good. Knowing that data centers are a huge asset to today's digital ages, with the 5G revolution, more users are moving to cloud computing and smart devices. Hence, Ascendas REIT has announced that it bought 11 data centers in Europe worth $960 million in March 2021. Now we will be revealing on the strategy to buy this REIT stock. Past trend. Ascendas REIT is trading at an average of 1.5 times of its net asset value, NAV. Currently, its NAV is at 2 Singapore dollars and 22 cents per unit. However, the stock price is trading at 2 Singapore dollars and 95 cents as of the 30th of June 2021. This is an attractive price to buy this REIT given that it is only 33% above NAV as compared to 50% above NAV in the past. After buying in this stock, you would need to consider when to sell and how long it will take to hold this portfolio. If you are looking at a good profit margin of 20% per annum, then the suggested price to sell is range between $3.50 to $3.70, depending on your transaction fees. Based on the current trend, you might need to have a minimum holding period of 1 year, depending on the market demand and sentiment as Singapore is in the recovering progress from COVID-19 pandemic. Second is CapitaLand Integrated Commercial Trust, CICT, SGX trading code C38U. CICT is managed by CapitaLand and Integrated Commercial Trust Management Limited, which is a wholly owned subsidiary of Singapore-listed CapitaLand Limited, which represents one of Asia's largest diversified real estate groups. Formerly, it was named as CapitaLand Mall Trust, CMT, and established as a property fund in October 2001. Since then, CMT has acquired 15 retail and integrated development properties with 11.8 billion Singapore dollars portfolio property value. In November 2020, the significant milestone achieved whereby CMT is merged with CapitaLand Commercial Trust, CCT, and renamed as CICT thereafter. After merger, CICT's portfolio consists of 24 properties with 22.4 billion Singapore dollars portfolio property value. Their portfolio are distributed in integrated developments, office and retails. To name it, Plaza Singapura, Raffles City Singapore, Bugis Junction, Tampines Mall, Westgate are some of CICT's iconic properties in Singapore. Also, CICT holds 94.9% interest in Galileo and Main Airport Center in Frankfurt, Germany. CICT is the largest REIT listed in SGX with a market capitalization of 14 billion Singapore dollars currently. Why should we buy CICT and when to buy the share? After merger, CICT is showing a better financial performance since Q4 2020. Its gross revenue and net property income for Q4 2020 increased by 36% and 36.4% respectively. This is mainly due to recovering of shopper traffic and tenant sales boosted by festive season. Also, Singapore has progressed into Phase 3 reopening starting the 28th of December 2020. To add on, distribution income for Q4 2020 has increased by 26.8% despite 22.4 million Singapore dollars worth of rental waivers. This is also credited to the contribution from Raffles City Singapore, which became a 100% owned property post-merger. In terms of dividend yield, CICT recorded 4.2% yield after merger. It is considered relatively healthy given the spike of COVID-19 in 2020. CICT's announcement in their annual report for financial year 2020 provides confidence to their investors. For retail segment, CICT maintained a high occupancy rate at 98%, which is higher than island-wide market occupancy rate of 91.2%. For office segment, their occupancy rate in Singapore office stands at 95.1%, which is 1.3% higher than the average occupancy rate in CBD areas. For integrated development properties, CICT maintained occupancy rate of 97.8% in 2020. The overall occupancy rate is encouraging and it is predicted to be better post-COVID as Singapore is planning on recovery stage after vaccinations completed. One thing worth mentioning here is that Funan Mall's occupancy rate increased by 0.8% in 2020 after refurbishment. For future development and growth, CICT's asset enhancement initiatives include Shopping Mall Lot 1 and office properties 6 Battery Road and 21 Collier Quay, are set to be completed in 2021. The redevelopment plan of Capital Spring is also on track to be completed by second half of 2021. Now we will be revealing on the strategy to buy this REIT stock. Currently, the NAV for CICT is amounted to 2 Singapore dollars and 1 cent and the stock price is trading at 2 Singapore dollars and 9 cents as of the 30th of June 2021. This is a good time to invest this stock for long-term value investing as it shows a good future prospect and development. However, it is not advisable to buy for short-term as CICT is less volatile as compared to other stocks in SGX. The weekly volatility is only up to 3% over the past year. Hence, it is currently at fair value, and if you are looking at a profit margin between 15% to 20% per annum, then the suggested price to sell is range between $2.40 to $2.60, depending on your transaction fees. The minimum holding period for this REIT is also 1 year, and personally we would suggest to hold this REIT for more than 2 years given the strong occupancy rates, future development and stable dividends. It is expected to have better financial performance after post-COVID-19 pandemic. Third is AIMS APAC REIT, SGX trading code 05RU. AIMS is managed by AIMS APAC REIT Management Limited, and it was listed in SGX as MacArthur Cook Industrial REIT since 2007. Initially, the portfolio for this REIT worth 316 million Singapore dollars, and it grows to a fund with estimated 1.82 billion Singapore dollars worth of assets currently. Today, their portfolio is diversified with 28 high-performing properties in strategic industrial hubs across Singapore and Australia. In Singapore, AIMS holds 26 properties with diversified portfolio whereby 50% of the rental income arising from logistics and warehouse, 16% from business park, 14% from general industrial, 11% from light industrial and 9% from high-tech space. In Australia, it has one business park in New South Wales worth 331 million Singapore dollars and one light industrial property in Queensland worth 46 million Singapore dollars. It has a market capitalization of 911.6 million Singapore dollars currently. Why should we buy AIMS and when to buy this share? Firstly, we can see a steady growth in revenue in the past 3 years. Particularly, there is a good improvement from 118.9 million Singapore dollars in 2020 to 122.6 million Singapore dollars in 2021. Even though an increase of 3% might not be fantastic, it is still encouraging, especially during COVID-19 pandemic. Next, it is showing a consistently high gross profit margin of at least 40% for 3 years. The improvement seen in 2021 is partially due to contributions from the recently acquired property at 7 Bulim Street, higher rental and recoveries for the properties at 3 Tuas Avenue 2, 20 Ghoul Way and 27 Penjuru Lane. As at the 31st of March 2021, the overall portfolio occupancy rate recorded at a healthy rate of 95.4%, which is above JTC Corporation's industry average of 90%. To add on, AIMS portfolio comprises of stable rental income whereby 32.4% of the gross rental income coming from master leases and 67.6% coming from multiple tenants. Optus Administration Private Limited is among AIMS' largest tenant, which contributes to 13% of gross rental income in 2021. It's worth mentioning that Optus Administration is having a remaining of 12 years master lease rental for Optus Centre in New South Wales, which provides a stable revenue outlook for this REIT. In Singapore, KWE Kintetsu World Express is the third largest tenant, which have a 10-year master lease that will only expire in 4 years' time. Its master lease also comes with a 5 years optional extension. The combination of master leases and multiple tenants profile allow AIMS to enjoy better cash flow visibility and stability, besides having flexibility to obtain higher positive rental reversions for those multiple tenants profile. In terms of dividend yield, AIMS recorded 7.3% yield as of March 2021. It is considered high yield and it shows a jump of 9% from 2020 dividend yield. The future prospect for this REIT is encouraging as logistics and warehouses have been in high demand since the outbreak of COVID-19 pandemic. This is due to the emergence of e-commerce and stockpiling as a result of change in buying habits during the pandemic. Now we will be revealing on the strategy to buy this REIT stock. Currently, The NAV for AIMS is amounted to $1.36 and the stock price is trading at $1.47 as of the 30th of June 2021. This is okay to buy now, or you can wait until the stock price is equivalent to NAV to be more prudent. With higher occupancy rate, earnings accretion from acquisitions, absence of rental rebates and lower interest expense, it is expected that the revenue will further growth in 2022. Hence, investing in AIMS is healthy with relatively high dividend yield. If you are looking at a profit margin between 10% to 15% per annum, then the suggested price to sell is range between $1.60 to $1.80, depending on your transaction fees. The minimum holding period for this REIT is 2 to 3 years. Some of the risks to consider before buying this REIT include unexpected defaults by master lease tenants, declines in asset value due to expiry in land leases, and potential oversupply of industrial space in 3 to 5 years. Hope you can have some useful insights on Singapore REITs that we shared after watching this video. Do comment and share with us your thoughts on the above REIT. Stay tuned and remember to share, like and subscribe our channel. I'm Sunny the Eggman. Goodbye.